This is WorkSpan TV. I'm Ryan Johnson from WorldatWork. I'm in the studio today with Blair Jones of Semler Brossy Consulting Group. Blair, welcome.
Thank you.
We're going to talk about shareholder communication and the importance that it's had in the last few years. Obviously, there's been a shift and an evolution in shareholder communication related to executive pay. I wonder if you could just talk about the shift that's occurred.
Yeah, I'd be glad to. I think that over the last 10 years, there's been a big move for companies to be more transparent about their executive pay programs, and a lot of that energy went into the CD&A. But now we're in an environment with Say on Pay, and investor groups have taken positions about how they feel about executive pay. So now, more than ever, it's really important for companies to own the communication they have with their shareholders around executive pay. And what that means, as I think about it, is that they need to be out front with their shareholders in the fall, before the proxy season even starts, having a dialogue with their key investors, talking about the programs they have in place, talking about key issues on the investor's mind, maybe preparing the investors for changes that are going to be made or big payouts that might be occurring, so that there's dialogue before anything hits the cutting room floor in the CD&A. And that gives the company a chance to tell their story and build relationships, but it also gives them a chance to hear what's on the investor's mind and identify any potential hot buttons so they can react when they have time to react, rather than when they're only a few weeks before a shareholder vote takes place.
So some of this is relatively new, these requirements in the CD&A, et cetera, in the last few years. It's a great example of something that a company should be doing, or companies should be doing. There's some things on the other side that companies probably shouldn't be doing. I mean, obviously communication is really good. The opposite is no communication. Are there other things that companies should be saying, boy, that's a practice we probably don't want to be doing anymore?
Well, I think what companies need to do is pick their battles. So, I think there's some things that they may feel very strongly about that they may hear in these pre-conversations, or from what they know with investors, may not sit as well with investors, but they feel it's really important to their business strategy. So therefore it makes sense to go ahead and communicate the rationale for that, whether it's with those investment groups or in the CD&A. But on others where it really doesn't make as much difference in terms of furthering the company goals, I think those are ones they could consider backing off on and maybe not pushing so hard. I also think that the old mantra of telling as little as possible just doesn't work anymore. That used to be the way all companies operated, was to obfuscate. And it just doesn't make any sense anymore. In fact, the more you tell, I think the more credit you get, because what investment groups are trying to do when they're looking at a lot of proxies is to figure out which ones are going to be okay and which ones they need to look at more deeply. And you want to be in the pile that they think are okay. So if you tell more, it gives them more confidence about your thought process. It gives them more insight into why you've made the decisions you've made, and more understanding of the history of where you've been and where you're going with your compensation programs.
So the imperative obviously is pay for performance. That's what everyone talks about. What are some things that companies can do today to demonstrate that, or think about as they formulate their pay plans for executives?
Well, I think you're right. If the CD&A communicates anything, or if these conversations with investors communicate anything, it should be how you think about the pay and performance relationship. And so this is another issue that companies really need to get ahead of. Right now, there are a lot of models floating out there and lots of advisory groups and institutions weighing in on it, and a company needs to tell their own story. So what that looks like is doing analysis of pay and performance historically, going back 5-6 years when the economy was doing well, going back just a couple of years when the economy was really in the tank, looking at today, and then looking at a number of other performance scenarios to really stress test your program and see how it might perform, both on an absolute basis, on a relative basis, how you perform on a variety of measures. You certainly would look at TSR, but you would also look at earnings and sales growth, and then you might look at other industry-specific measures. You want to get it from every angle so that you're sure that you understand what's the dynamics are underlying your compensation programs, and that you're able to talk about those clearly. Now, in some cases, it may mean that you need to change some things about your program, but that's better, again, to know now rather than having to react to it when someone puts you through a model. So I think, whether it helps you clarify your story and make that something you can talk about in your CD&A clearly and help investors understand how it's going to play out, or it helps you modify your program to make it better aligned, I think you're in much better shape if you go through that process.
Well, Blair, I want to thank you for coming in today. It's Blair Jones from the Semler Brossy Consulting Group. And for WorldatWork and WorkSpan TV, I'm Ryan Johnson.